Alright everyone, Cowboy Trades here. Welcome back to the channel for another update on the S&P 500. Today we're going to be discussing, has a US recession already been confirmed? And if it is confirmed, how long approximately do we have to wait until that recession finally kicks in? If you're a veteran of the channel, you'll recognize a few of the charts that we'll pull up today, but we do also have a new chart to discuss which we haven't talked about before. So let's dive right into this new chart. What we're looking at over on the screen with this blue line is we're tracking the US government bonds on a 2-year yield basis. Like I said, veterans of the channel will be very familiar with this. We do cover the 2-year government bonds, but what we are also overlaying on this chart is these green vertical bars. This is an indicator which highlights the US recessions. We have the major recessions being in the 1989 Gulf War, in the 2000 tech stock bubble, in the 2008 subprime financial crisis, and of course the event that happened in March of 2020. If we come over to the yield curve, which is the 10-year government bonds minus the 2-year government bonds, what you can see is when the yield curve inverts, this has previously predicted all of these major recessions which we've been tracking on our charts. But let's dive into the new chart before we discuss that in any further detail. So when we are looking at the US government bonds on a 2-year yield basis, when these go on major rallies to the upside, the bonds which have a lower maturity date being 3-month, 6-month, 1-year and 2-year government bonds, these often heavily outpace the returns of higher time frame bonds. So you often see whenever bonds are rallying, the 2-year goes on an exponential run to the upside and massively outperforms the 10-year, which is why when you're getting the 10-year government bond minus the 2-year government bonds, you see these deep inversions of the yield curve, which are known for predicting recessions. When we are looking at this chart over here, we're seeing a very similar picture when you are looking at when the yield market finally starts to top out. You can see coming into the Gulf War of 89, it took about 488 days before that major recession hit the US and crashed the markets. Over in the 2000 financial crisis, you saw that it took government bonds about 304 days to top out before that recession was confirmed. Over in the 2007, coming into the 2008 subprime financial crisis, when we saw this deep inversion of the yield curve. Finally, when we saw the yield curve bottom in Q1 of 2007, when we come over to this chart here, you can see it took about 214 days from that top in the 2-year government bonds for a recession to be confirmed in the markets. Over in 2018, you saw that it took 487 days for the top in the 2-year government bonds to finally bleed into a recession. If we come over to the compare symbol and we overlay the S&P 500 at the bottom of our chart down here, what you can see is, it's kind of hard to see with this 89 one, but we did have about a 20% crash back when the S&P 500 was trading in the Gulf War. If we reset this chart back over here, you can see we had some very significant crashes back in these major recessions over here. These are the main ones that I look at on the channel: the 2000 tech stock bubble, 2008 subprime mortgage crisis, and of course what I believe we're witnessing right now. You can see coming into the 2000 financial crisis, once we finally had that recession confirmed about 304 days after government bonds topped out, the markets absolutely continued to melt to the downside. For the S&P 500, a major meltdown continued for a very long time. Over here, you can see, once again, the top of the government bonds pretty much correlated with the top in the equity markets back here. And when that recession was finally confirmed, when we're seeing this chart tick into green, we had a major crash for the markets 200 days after. You can see over here as well, once that recession was confirmed, we did have a major meltdown to the downside. This was of course a black swan event, so whether you want to take this data point into consideration or not, that is up for you. I will leave that one up in the airs. But if we do add all of these dates, 488 days, 304 days, 214 days, 487 days, we add all these up together and we divide by 4 to get the average, you can see it took about 373 days to have a recession after the 2-year government bonds topped out. Now, we are looking at the weekly time frame on TradingView, so the closest I can get to this is 365 days, but you can imagine about in 373 days from the top, this is potentially where we could be expecting the next major recession in the equity markets, and this is where you may see something like this come over on our indicators. Like I said, this is just an indicator over here that shows you the US recessions. If you want to find this one, just head over to indicators and type in US recessions. I've only used this for the first time today. This is the indicator that I'm using is by someone called Chris M665. Nonetheless, I do think I'll be using this in future videos. Very interesting and very easy to just overlay this instead of, counting back at the days. But yeah, like I said, if we are looking at the extrapolation of this, potentially we could see a recession come into February of 2024. Now, why does this so beautifully line up? Why would a recession happen early 2024? Well, what has the Fed been talking about with the interest rates? The Fed has been saying we are not going to cut interest rates until 2024. So what has previously happened whenever we've had cuts of interest rates in the markets? Well, let's overlay these charts and take a look. Over here in 89, you can see we had that cut in the interest rates, the recession was confirmed, and we did have a crash in the equity markets. Over here, you can see the top in the S&P 500 correlated with a top in the interest rates. The interest rates are this blue line, and the S&P 500 is this green line down here. You can see once the interest rates were cut over here, boom, we had a major crash to the downside once the interest rates were cut. Over here, you can see the top in the S&P 500 pretty much beautifully lined up with the top in the interest rates. We actually had a cut in the interest rates. The markets rallied for a month or so, and then they absolutely melted to the downside as the interest rates were cut further. And as the interest rates were cut, we had a recession. It's very beautiful to see. Over here, you can see interest rates were cut in 89. We had a recession in 90. Over here, interest rates were cut coming into the year 2000. We had a recession in 2001. Over here, you can see the interest rates were cut in 2007. We had a recession late 2007 coming into 2008. Over here, you can see interest rates were cut in June of 2019. We had a recession in March of 2020. Like I said, this one is a black swan event, so whether you want to take this one into consideration or not, that is completely up to you. But I do just want to point out the similarities between these two. It's very interesting to see that if this chart once again repeats itself, if the bond market does start breaking to the downside, and we do have that recession confirmed in Q1 of 2024, then this would beautifully line up with when the Fed have been saying they're going to cut the interest rates, and then we'd have multiple charts lining up screaming that a recession is confirmed. But basically, interest rates are at super high levels. They've got to cut these at some point. That is pretty much going to cause a recession. The US government bonds on a 2-year basis, they're extremely overextended right now. Look at where they topped out. They topped out just before the 2000 tech stock bubble. They topped out where they did in 2007, 2006, before the 2008 financial crisis. I don't think there's too much further that government bonds can go to the upside. Can they take another small run to the upside? Can they bounce back up and double top before breaking down? It's possible, but we're super overextended right now, and typically when this happens, when we start breaking down for the government bonds, it's pretty linear. They go on a straight run to the upside and a straight run to the downside, straight run to the upside, straight run to the downside. We've had one of the fastest tears to the upside for the US government bonds in history. So with this, because we've had 2-year government bonds take a monumental tear to the upside, this is why we're seeing the yield curve, which once again, remember, is simply the summation of the 10-year government bonds returns minus the summation of the 2-year government bonds returns. So when we get this, we're just minusing the 2-year government bonds by the 10-year government bonds. As we discussed, coming into recessions, the 2-year always outperforms the 10-year, which is why we've got such a drastic number to take away. You can imagine if the rate for the 2-year government bonds is, let's say, 5%, but the rate for the 10-year government bonds is only 3%, then 3 minus 5 is minus 2. So this is why when you have the 2-year government bond going on a massive tear to the upside, the yield curve is inverted and it goes to these negative targets. Now you can see this red box that marked the lows of the yield curve before the recession in 1990. The yield curve marked the bottom in 2000 over here, and we came into this box again in the 2008 financial crisis. If we zoom into what's happening right now, the yield curve has destroyed this box. The yield curve being the bond market is currently predicting the worst recession that we've ever seen in US history. And this is really what I want to wrap up on, as we've discussed in this chart over here. When the 2-year government bonds start to break to the downside, this is typically when you see the yield curve start to go back up to the upside, because the 2-year government bond starts going down faster than the 10-year, and subsequently we see this reversion back to the upside. So when you see these bottoms in the yield curve market, you can see we had a rally back up, and then once we were all the way back up here for the yield curve, this is when you see this recession flash once again. In the year 2000, we bottomed on the yield curve, we broke back up to the upside, and this marked, once we were coming down to these lows here, this was basically confirming a recession. We had that recession not long after. In 2007, leading into the 2008 financial crisis, we came down into this red box again. Once we reverted back up for the yield curve, this is when the recession was confirmed. Over here in the 2000 financial crisis, once again, we came almost down to this red box. Once we reverted back to the top, that recession was confirmed. If the yield curve starts going to the upside very, very soon, which is going to be an indicator that the 2-year government bond is going to start breaking to the downside, we're going to see confirmation from this chart over here, letting us know the 2-year government bonds are predicting a recession. We're going to see confirmation on the yield curve predicting a recession is going to come, and this is probably going to line up with coming into late 2023, maybe coming into Q1 of 2024, when the Fed are soon going to start pausing their interest rates. And when we see that cut, this chart over here showing us the history of interest rate cuts and recessions, removing the S&P 500, we've already talked about how interest rate cuts cause major crashes in the S&P 500. If we're looking at these major data points we've been looking at, when the Fed cut the interest rates in 89, 2000 and 2008, this all caused a recession in the market. So it looks like a lot of these charts are basically confirming a recession at this moment in time. I do believe that recession is going to be confirmed in Q1 of 2024, maybe January, maybe February. That's just an approximate date for you. But with that being said, that would obviously mean that the bear market still probably has about another year, maybe a year and 3 months, maybe a year and 6 months before we could potentially see a bottom in the equity markets and the cryptocurrency markets. That's really all I've got for the major posts today. I also recorded a video just before this discussing how corporate insiders are selling their stocks at this moment in time. I haven't yet uploaded this, but if you are watching this video now on recessions, I would have already uploaded that. So if you want insight into what's currently happening with corporate insiders selling their stocks, what's previously happened looking at these previous data points on the S&P 500 when insiders sell, and also if you want a tiny bit of TA to go with this recession analysis, then be sure to check out the most recent video we uploaded. Corporate insiders are selling again. But just to quickly show you in this chart over here, you can see, once again, tiny bit of TA to go with this video. We are at a major area of resistance for the S&P 500 right now. Corporate insiders are selling into this most recent rally, and we're also finding ourselves at the top of a 5-wave asymmetrical triangle, which in a bear market, when you break into these symmetrical triangles, this is a continuation pattern. You can see we've had wave A, wave B, wave C, wave D, and wave E. If we look at this cheat sheet over here, you can see wave E right here should be the top of this asymmetrical triangle, and we should start breaking to the downside. Pair this with the fact that we're currently at a major area of resistance for the S&P 500, pairing this with the fact that insiders are currently selling, it's not looking good for the short-term outlook of the S&P 500. And also, as we've discussed in this video, looking at these major charts, it's also not looking too good in the higher time frame. So in my opinion, my friends, a recession is pretty much confirmed. When do I think this is coming? January, February, maybe March of 2024. Obviously, this is Q1 2024. This is my prediction. So for today, my friends, that's all I've got. If you do enjoy my videos, as always, let me know down below by leaving a like and a comment. Share the videos with your friends. If you want to further support the channel, feel free to click the join button and become a member today. Make sure to follow me over on Twitter at 618_cowboy. I'll leave it here. It's been your boy Cowboy Trades. I'm out. Peace.